Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. Me, Ryan Huang. And we are heading into this week with yet another slew of tariff action and news. So the European Union has criticized U.S. President Donald Trump's move to hike tariffs on steel imports, saying it adds further uncertainty to the global economy. And you might remember last Friday, Donald Trump saying he will double tariffs on steel imports to 50% from 25%. And the EU says it is prepared to impose countermeasures, including in response to the latest U.S. tariff increase. So lots going on as we look forward to the rest of the week, and helping us out is Eddy Loh. He is the Chief Investment Officer for Maybank, Singapore's Group Wealth Management. Eddy, good morning. How are you doing today?
Morning, Ryan. Very good.
All right. Very good. I'm sure very busy as well, keeping track of what's going on. So how are we setting up for markets this week as we kick off June in what has been quite a back and forth when it comes to the tariff environment?
Indeed. When we look at the equity markets, global equities have actually staged a very strong rebound in May with the de-escalation of trade war. However, as we have seen in last week's headline, there could be still more twists and turns ahead, even though we may be past peak trade uncertainty. As you mentioned earlier, Trump is looking to double steel tariffs to 50%. On 4th of June, Europe said it will impose and retaliate. Meanwhile, we still have this court rulings over tariffs last week, and that could eventually make its way to the Supreme Court and result in a prolonged legal battle that could stretch on for months. So overall, it does not really look like we will be able to get clarity on the tariff front before the expiry of the 90-day pause on 9th of July, and that could lead to renewed concerns and market volatility in the coming weeks.
Yeah, good overview, Eddy. I think it's not just tariffs, but also non-tariff measures that are also at play here. China is calling out Donald Trump for what they describe as abuse of semiconductor export controls. So you also have the US-China angle at play here. How is this going to play out for them, especially when you look at how China's economy is going through some headwinds, in terms of the latest data showing contraction in some of their numbers for manufacturing. So they've been trying to revive the economy. Is there now more urgency for them to push out more stimulus measures with this current backdrop?
Well, China said that U.S. is abusing, export controls after the U.S. banned American companies from importing or even using AI chips from the likes of Huawei. And in the meantime, President Trump just said last week that China has totally violated the trade truce. So we won't be surprised to see, tariffs going back up again, even before the expiry of the truce, which is supposed to end in early August. But if you look at Chinese economy, no doubt, I think there are some pressures, and the trade tariffs doesn't really help. But what we have seen is that the Chinese policy leaders have actually expressed very strong policy commitment to backstop the economy, and we think that they will continue to implement measures to support the economy, especially on the domestic front, and to mitigate the trade impact. Notably, China's reliance on export to the U.S. has actually reduced since Trump 1.0. And in the meantime, it's not just the Chinese companies. U.S. companies are also being affected by this trade war. If you look at last week's NVIDIA's result announcement, CEO Jensen Huang said that they will be missing out on $8 billion of sales as it can no longer supply its chip to China. So I think that slowing U.S. growth and pressure on the U.S. businesses could also apply pressure on the Trump administration on the tariffs front.
Okay, talking about pressure, maybe we could get some reprieve with where energy prices are right now. Looking at oil prices, year to date, they are down at least 13%. If you look at WTI, 14% for Brent. And we are getting reports that OPEC Plus is looking to increase supply. So there's going to be more pressure, I suppose, when it comes to energy prices. What's the thinking here when you see them trying to increase prices or increase supply against a backdrop of what has been a rather tough economic outlook?
Well, oil prices have actually remained pretty subdued year to date, given the rising supply, as well as that soft demand outlook, partly contributed by the tariff conflict. So I think it was somewhat surprising to some market observers that, hey, why is the OPEC still hiking their supply, right? In fact, the latest OPEC output hike of 400,000 barrels per day in July remains a puzzle to many, but we can understand that one of the potential reasons is because I think the hike reflected Saudi Arabia's desire to punish some of the overproducing members, like, for example, Kazakhstan and Iraq. And in some ways, the output hike could also help OPEC Plus recoup market share that was being lost to the U.S. shale producers. Now, having said that, the higher supply will limit further price increase, barring any unexpected escalation in geopolitical tensions. But the only saving grace here, a positive that we can take away, is lower energy prices. At least that will keep actually inflation in check.
Okay, so we've got a couple of things playing out in the coming weeks and months. So with that backdrop, how are you approaching markets right now when you have all this uncertainty, Eddy?
Right. I think although risk and sentiment has improved, volatility could spike again given the policy risks on multiple fronts, be it on U.S. trade tariffs, fiscal, or even monetary policies. Notably, we are still looking out or monitoring the situation on President Trump's big, beautiful budget bill that has reignited fiscal concerns in the U.S. So we are actually turning more cautious towards global equities given the rebound in May, especially for U.S. stocks given the limited valuation buffer. Now, having said that, we still see opportunities in market and sectors with resilient domestic exposure and lower sensitivity to tariff developments. At the same time, I think we will continue to seek resilient carry from quality credit, including opportunities in non-U.S. dollar bonds for better diversification. So overall, maintain a strong focus in building portfolio resilience, have some cash buffer to mitigate the near-term downside risk. And of course, I think gold remains a very strategic asset for us to own in our portfolio asset allocation, given the very strong structural demand.
All right, just to expand on that, you mentioned the big, beautiful bill that's raised concerns around the U.S. deficit and also has seen a bit of a sell America narrative going on. So out of America, going to other markets, where are some of the opportunities you're looking at right now? What's some of the sectors you're thinking of looking at more closely?
Right. I think within equities itself, while Asia and China equities inexpensively valued, we think that the near-term gains may somewhat be affected by this ongoing trade uncertainty. But as I mentioned, the domestic-oriented sectors, say, for example, within China, those consumption-related plays, travel-related plays, I think those are an area for us to focus on. And then within Singapore, if you look at the Singapore REIT, valuation is actually very inexpensive. They are offering dividend yields of about, on average, about 6.5%, trading at a pretty attractive yield above the 10-year Singapore government bond yields. So that is actually an interesting area for us. And also on the bond side, what we are also hearing from our clients and investors is that U.S. dollar bonds is always the staple for many of our bond investors, but increasingly, people are looking for Euro bonds, denominated bonds, Aussie denominated bonds, or even Singapore denominated bonds for better diversification across the bond investment. So all in all, I think there is an inclination to move a little bit away from U.S. dollar assets. But having said that, we don't think it means that Treasuries is going to just disappear from investors' portfolio all at one go, especially for U.S. Treasuries. The market is just simply too big, too liquid for any alternatives to replace them at this juncture. So at this juncture, diversify, but I think there's still merits to hold on to some U.S. dollar assets at the same time.
All right, time to look at diversifying your portfolio as we navigate some of these uncertainties. And we have been in conversation with Eddy Loh. He is the CIO for Maybank Singapore's Group Wealth Management. Eddy, thanks for your time this morning.
Right, thank you very much.
Always great chatting with you. Stay on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.